I'll get started here. Good morning, everybody, or afternoon. My name is Barry Zimmermann. I'm BGA Insurance, obviously. We put this out there kind of quickly. It says in the title that this is important, and this is highly important. This is coming our way in 14, 15 different states, and it's coming pretty quickly. Jen White, who is going to be our host today from John Hancock, is an expert in this field, and she'll prove that pretty quickly to you guys. So this is a tax potentially to an awful lot of people around this country. This is a byproduct of the COVID pandemic and what's happened to Medicare and how they're going to come to all of us to gain new taxes to pay for anything in the future. Or it's an election of our own to find a product that we all sell that will get us out of that tax and do great things for us. So with that, Jen, if you want to take over, maybe mute us all and
Sure.
let us come in we can raise our hands in this thing if we have questions along the way.
Sure. Yeah. Feel free to, interrupt me if there's a question that's burning. I don't know how to mute everybody though. So maybe if everybody just wants to mute themselves while we get started, and if we hear some background noise, we'll kind of just pause for a minute. So thank you for having me, Barry. This is it's such a fluid topic, and this has been going on since, the Washington Walk Here's program, which we'll talk a little bit about too. But I think the one thing that's really an important thing to think about, and if you've been in this industry for any length of time, you might realize that this is not a new problem that the states are trying to solve. It's not a new problem that the federal government's trying to solve. This has been an ongoing problem. And it's the problem known as long-term care. But going back, if anybody was in the long-term care insurance business, you may have been familiar with partnership policies, right? And partnership policies were these types of long-term care insurance products that people could buy. And they granted the purchaser a certain level of asset protection from Medicaid if they ever ultimately qualified for that. So the purpose of the partnership policies was like a grant from the Robert Wood Johnson Foundation. They funded these initial partnership programs in 4 states. California was one of them. But the objectives of these programs, I just want you to think about this for a minute, were to improve consumers' awareness of the challenges of financing long-term care. We're kind of in the middle of that now. Reduce consumers' fears of impoverishment due to long-term care. Again, this is where we are today. Make long-term care insurance more readily available to consumers. And I think we're doing that in a tremendous way by creating so many different types of products to reach different consumers with where they are in different planning opportunities. And then, of course, the most important one for the states is cap the use of public expenditures, primarily through Medicaid, for long-term care financing. So if you think about those things, were kind of the intent of the partnership programs originated back in the 80s. So here we are still with trying to solve this problem known as long-term care. So the states are looking at it from a different lens now, and it's through these payroll tax deductions. And California is putting a little tweak on that, so we'll talk a little bit more about that. But it's important to really understand kind of what's driving this, which is what we just talked about, those concerns at the state level, that raising awareness about there's nothing else that's going to pay for long-term care except your client's finances or the labor of their family members, right? Which is the informal caregivers. So let's just take a look. And I know a lot of people on this call probably lived through Walk Here's, have the scars from Walk Here's, or maybe they benefited from Walk Here's. But, California is following Washington in some regard, but they're also taking some additional steps, which I think are going to allow for a better program. So let's just recap what happened in the state of Washington. So Walk Here's was the first payroll-funded long-term care program that was initiated by a state. And it was funded by Washington workers' wages. They were taxed at 58 cents per $100 earned. And the most important thing to understand about this is that there was no contribution cap. So high income earners, people who are making a really great living, were going to be paying an awful lot more into a program than they could ever get from the Walk Here's fund. The lifetime benefit was $36,500. Of course, that's indexed for inflation. But really, people could end up paying more into the program than they could ever receive in benefits if they even stayed in Washington, right? Because that was one of the problems with Walk Here's, is that benefits were only payable or are only payable in the state of Washington. So just this past July 1st, was the actual implementation. They had delayed the initial launch of walk hairs just because there were so many problems with the program as it stood. They were hit with class action lawsuits from some of the neighboring states of Washington workers who would be forced to contribute to the fund, but would never be eligible for benefits because they didn't live in Washington. So the delay allowed the state of Washington, or the Walk Hairs Committee, to try to resolve some of the issues that were part of the Walk Hairs program. So implementation was delayed till July 1st of this year. So far, it's been somewhat quiet. But there is one thing I think we should probably make sure everyone's aware of, and that is the delay allowed for a new type of exemption. So the original exemption that we were all taking advantage of was, people could opt out if they bought private insurance, right? If they were able to buy private insurance prior to November 1st of 2021, they could opt out of walk hairs, not pay into the fund, and have their own private insurance. What they've allowed for now through this delay is really trying to address the concern about those people either living in neighboring states and driving or commuting to Washington for their job, or people who work remotely for a Washington-based company, such as Amazon or Boeing. So right now, through the end of the year, if you have clients who fit these criteria, as you see on the screen here, they might live outside of Washington, or they're in categories that they likely would not qualify to receive benefits under this program. These folks can request an exemption from walk hairs between now and the end of the year. And they don't have to own private insurance. So this is one thing that came from the delay. So anybody in those situations, if you have clients, always a good reason to call, right? And here's one: they don't have to own private insurance, and they can simply request an exemption from walk hairs if they're in one of these categories. What the delay did not address yet was the portability of benefits. So in its present form, walk hairs is still only paying benefits for people who live in the state of Washington. So they're still looking to address the portability. So somebody, think about somebody who might be working and they decide to retire somewhere else, maybe somewhere south where it's a little warmer. They might have paid into this program for 30, 35 years. They decide to move to Florida. They're no longer eligible for walk hairs benefits, despite paying all those payroll taxes. So they're still looking to address that. The recertification of private long-term care insurance. This was something that was really challenging for us as a carrier, which was, the snapshot of time, which was this exemption timeline. People could literally purchase insurance, request an exemption, and then lapse that policy, which was the biggest fear from the carrier. And I'm sure for a lot of you who sold these products, right, you don't need chargebacks. So they're looking at creating some sort of recertification for people who do have an exemption because they own private insurance. What they're kind of proposing is maybe having some sort of recertification requirement every 2 years. And then maybe after a 10-year period, they no longer need to recertify. But that's still all up in the air and nothing's been decided. This is just some of what's being discussed, and really unfortunate to say this, that it's keeping the business on the books, right? Because if people need to recertify, they're not going to let go of that and now all of a sudden be opted into a program they were looking to avoid. And then the last one is a creation of a private supplemental LTC insurance program, which is a really great thing. But I think it's a bit of a challenge, because for anybody who's paid attention to Washington, to qualify for benefits, it's 3 activities of daily living out of, I think it's like 9 or 10 or 11 qualifying triggers. So it's different than what we see in the private market. When you think about tax qualified long-term care, 2 out of 6 activities of daily living, the NAIC model regs tell us that. So when Washington decided, hey, wouldn't it be great if we worked with the private sector to come up with these wraparound products where somebody uses up their walk hairs benefit, then the private insurance would be able to take over from there. Great idea, but they came into it a little bit late. It's very challenging to create wraparound products with different benefit triggers. So this is like what Washington is currently still working on. And I'm just really happy to know that, it's not dead in the water. They're still looking to create and make changes to it that will hopefully turn it into a better program. But right now, people who couldn't qualify for long-term care insurance, couldn't afford long-term care insurance, those are the people who are probably going to benefit the most from walk hairs. but anybody of means, high income earners, or people who don't plan to live in Washington state in its present condition probably aren't going to benefit a whole lot from WACARES if they have private insurance instead. So that's kind of a recap. We're going to take a look at now the states that are up next. And I think a lot of you are doing business in the state of California, which is next up on the docket. I think the thing to know here is that unlike Washington, where they created almost a 6-month fire sale opportunity for people to race out, sell long-term care insurance products, buy long-term care insurance products, almost shut down an entire long-term care industry. We're probably not going to see that from California or any other state proposing some sort of long-term care program. What they're proposing is any type of opt-out, which they do address, and we do expect to see some sort of opt-out from the state of California and potentially some other states as well. But the opt-out is something that will be established to have, the private insurance is something that would have to have been purchased prior to that state's legislation taking effect. So if you think about state legislation that might take effect January 1st, 2024, what California is proposing is that private coverage would have to be purchased prior to January 1st, 2024. So this is where we're seeing a lot of people really trying to seize an opportunity of going out there, capitalizing on this increased awareness about long-term care initiatives, long-term care state initiatives, and really trying to leverage this opportunity to have those conversations with their clients, because by the time the legislation gets passed, if it gets passed, it will be too late to create this kind of opt-out opportunity for your clients. But even if they don't opt out at that moment in time, California may have a solution. So we'll get into a little bit of that. So here's what we have right now. California's created a task force, and the task force has already come up with 5 different proposed plans for what a long-term care program could look like in the state of California. The 5 plans range in benefit levels. As you can see, that 36.5 looks a little familiar, similar to the state of Washington, but it ranges all the way up to $144,000 in lifetime benefits. So they consider it, lower end and then higher end benefits. And the actuarial company, Oliver Wyman, is now pricing out each of these options right now. And I have a note here that I was just researching this. Some of the initial costs just associated what Oliver Wyman is proposing, just in these initial plans as proposed in the task force recommendations and the feasibility report. For the lower cost benefits, they're looking at a cost somewhere around Washington. So 40 to 60 cents per $100 earned, okay, for those lower end benefits. If you're looking at those higher range benefits, that 81,000 through 144,000, the cost of that, they're looking at it being somewhere between 2 and 3.5% payroll tax, which is a lot of money, right, for somebody to be paying out. Even though the benefits are more, it's going to be a significant impact on people's payroll. So the other thing to keep in mind too is that this is not likely going to be just an employee issue. What they're proposing is that it's a joint tax between employees and employers, as well as an income tax for self-employed individuals. So this is something I think that's a lot broader than what we saw in the state of Washington, which was just a tax on the Washington workers' wages. Washington workers' wages. I like that. Okay. But then this is something where the employer is potentially now going to be responsible for contributing the worker, and then self-employed individuals who would have had to, can somebody mute their phone, please?
The pole right across my property.
Cindy, can you mute your phone?
Oh, there we go.
The electricity lines all like, living space, outside living space. So I was wondering that if you, and I said kind of remove the power to.
I don't know if somebody can chat.
So that the electricity line is not going to be right in front of my backyard. So.
Cindy, you have to mute your phone.
I think we're good. All right. Okay, so continuing on. So that's kind of just a snapshot of like what some of the things are in the state of California. Again, we don't have all the answers yet. We don't know what this is going to look like, right? So just some of the next steps, and then we'll talk a little bit about the opt-out of what's being proposed. So next step is this actuarial report, the one that's going to be pricing out these 5 different options, is due to be circulated September 1st or by September 1st. And then the whole study will be completed by January 1st. And the task force can go ahead and say, we want to make changes to the program that, of course, could impact the pricing of the program, but it will go back to the task force for any recommendations. Now, the important thing to know is that even if we get this actuarial study, the task force makes its recommendations, legislation still has to be passed in order for a state program to take effect in California. So just because the task force completes this doesn't mean a state tax is going to be implemented January 1st of next year. I'm not saying we don't have an opportunity. I'm just saying we just don't know what it means yet. We do need legislation in order for this to take effect. So what we're all interested in is, what is the opt-out going to look like, right? So everything still is TBD, but they do specifically address what an opt-out would be and how it's going to be designed. Now, the one thing, and I took this literally from the FAQs, and I can send this to you, this actual presentation. These have hyperlinks within it, so you can, access some of the actual documents from the DOI website and the feasibility report itself. But this addresses the opt-out. Now, one of the questions is, what types of insurance are going to be eligible for opt-out? In the state of Washington, we saw that it was all 7702B products. So your standalone long-term care insurance, your hybrid LTC products, and your life insurance with LTC riders. What was not included were chronic illness riders. So your benefit access rider from Prudential and some of those back-ended chronic illness riders. We just launched one back in July of last year, or 2 years ago now. So anything long-term care, 7702B, was considered eligible products for purposes of opting out in Washington. California has not come out and said that yet. I know they're being lobbied very, very hard to include chronic illness riders as part of the products that would be eligible for an exemption. Now, is this good? Is this bad? I don't know. I mean, to get to like the whole purpose of why they're doing this is really to help defray Medicaid spending. Would a chronic illness rider and a long-term care rider, if they both have that monthly charge, defined benefit, would they both help in that goal of defraying Medicaid spending? Absolutely. But we have to count on the DOI and the task force and everybody else to understand the difference between chronic illnesses that you pay for on a monthly basis and chronic illness riders that you simply pay for if you decide to use the benefits. Should both of those be eligible for an exemption? Probably not, because if you haven't paid for it, you don't have to take the benefits. There's really kind of no reason to give somebody an exemption from the program. They're not paying for anything. So if the states can actually get to the point where they understand those differences and are able to establish criteria for people to know exactly what type of chronic illness rider does and doesn't qualify, maybe we will see that. But at the present time, if we look to Washington actually never addressed chronic illness riders, but they did address critical illness riders, which is what gives me very little confidence that the states really understand the nuances in these types of products. 7702B products are very well defined, very well regulated, and I think that almost is an easier path to go. But again, we don't know yet. So we're waiting for what is private insurance to be defined. The other thing is what is the minimum criteria that somebody would need to purchase for private insurance in order to be eligible for an exemption. And I was talking to somebody the other day about this, and they said, what was Washington's, 100,000? And I said, no, I said, there was a lot of rumors about the minimum in Washington, but Washington actually never established a minimum amount of coverage. I think people assumed if they bought at least 36.5, they would be able to, request an exemption, but there was literally no minimum. So I think that's where a lot of the carriers just kind of saw these teeny tiny policies being applied for and purchased, which is, again, what almost shut down an entire industry. So what California is doing within their task force is establishing these like subcommittees, and the subcommittees will be looking at the different insurance options, determining what products and what amounts would be eligible for an exemption. So I sit here before you today and tell you, we don't know what the opt-out is going to look like, right? We don't know. We don't know the amount, the type of insurance, the kind of insurance, the amount of insurance, but we know there's potentially going to be this opt-out. And so when we talk about it, it's like, well, what do I do? How do I sell this to my client if they have to have it in place prior to the legislation taking effect, which ultimately will define these things for us? And I don't have the greatest answer for you because I don't know, but it all goes back to that doing sound financial planning and long-term care planning with your clients is the first step, right? Like talking to clients about this. This is something that awareness is at an all-time high. And there's other states that are looking at this, and I'll show you on the next slide just some of the other initiatives. But we're going to have to talk to clients about this prior to the opportunity for a fire sale because we're not going to have one. So I was talking to a gentleman this week, and he had a very, very high net worth client living in the state of Washington. Because of his background, profession, health, whatever it was, he was not able to purchase long-term care insurance despite making about $30 million a year. Think about the tax in that perspective of somebody whose wages were $30 million. I wasn't even thinking about that as I've been doing this presentation for almost a year and a half now. I was thinking about, your high income earners at, $1, $2, $3, $5 million, but think about it from the perspective of $30 million, right? Now apply this in California. Think about people working for Airbnb, Facebook, Apple, Google. We have some of the largest companies out there with high income earners. This is going to be something that hits them directly, not just the employees, but potentially the employers. So it's worth having the discussions now, despite not knowing. And if you think about risk and consequence, right? And we think about that. This is how we talk about long-term care, how we talk about life insurance. You might not realize you talk about it when you talk about life insurance, but really we sell insurance based on consequences of inactivity. If you don't buy life insurance, something happens to you during your working years. What are the consequences to your family and their lifestyle? Long-term care, if you don't have a plan in place to pay for long-term care expenses, should you need care, what are the consequences to your family and financial portfolio? So this is another consequence-based planning opportunity. If you don't address this with your clients now, despite not knowing what these minimums are, then there's consequences to that. Should something be established and there's an opportunity to opt out. So am I saying go out and sell $144,000 that is a minimum product? No, I'm saying do that type of planning with your clients. This is a bullet point in that conversation, which is, you know what? Your state might be creating some sort of incentive to help you have an opportunity to do your own planning rather than participate in a state program. If you have qualifying long-term care insurance, that's probably going to be the best chance of you opting out, but chronic illness can qualify. And minimum amounts, don't know, but could $250,000 to $500,000 worth of coverage be a safe bet? That's probably where I would probably lay my safety net. But these are just some of the discussions we have to have now because you're not going to have an opportunity to have them once legislation is impacted or is enacted, excuse me. So let's just take a look at just some of the other initiatives. And I keep saying, they're state initiatives, they're not necessarily state legislation, because all of these you'll see on the screen here are not going to end up as legislation. But there are states that are doing studies to help determine whether or not they're going to take actions and what kind of actions they're going to take. Massachusetts was the latest one to just be added. So I'll leave this up just for a minute so you can take a look. But again, each of these here will link you. If anybody's an LTC nerd and wants to go in and read some of these proposals in detail, you'll be able to do that. So this was my long-term care awareness message from last year, right? And
Hey,
I would say if it looks like a duck, walks like a duck, acts like a duck, that it's a duck, right? But not necessarily. Barry, are you chiming in with something?
Yeah, I am. I'm sorry.
Please.
I'm getting
No, go right ahead.
a lot of messages. I have
Okay,
this
great.
presentation.
Mhm.
And for everybody, I'll share this. Email us afterwards, and myself afterwards, and I'll share. If that's okay with you, Jen, right?
Absolutely. Yep.
Okay.
Compliance approved.
Do I have the most current version? I know you update this pretty fluidly.
Yep. The version should say June version 2 down the right-hand bottom.
Okay, I'll check.
I think I did send it to you, I think, but I'll double check.
Okay. All right. So I can get this out to everybody. Thanks. Thanks, Jen.
Okay, great. Thank you. So this was kind of the LTC awareness message I had been doing for November in our long-term care awareness month. And usually that focuses on raising awareness around consumers and needing to plan for long-term care. But really it was getting advisors to understand the products that they sell. And just because something might look like long-term care insurance, it doesn't mean it is long-term care insurance. So what I think Washington did was really draw a line in the sand to say what is and isn't long-term care insurance. And I think about people who may have bought a chronic illness rider that has a monthly charge, or, and it has a defined benefit. So it does look a lot like long-term care insurance and they're paying for it. But what the exemption in the state of Washington, even if they owned a chronic illness rider that functioned like that, they were not eligible for an exemption. So I would propose to you, the biggest question that the most dangerous call you ever want to get from a client is, their daughter saying, my dad's in a hospital, he's going to be moved home, he needs 24-hour care because he suffered a series of strokes. How are we going to pay for his care that he's going to need? And you as the advisor is like, oh, good news, you found about long-term care insurance, we got this covered. You planned ahead, right? And you can actually answer them. But now the question is, you did this planning and you sold the father a chronic illness rider. He's still working, right? And he calls and says, oh, my state has this payroll tax and I bought long-term care insurance, right? I can opt out. And you say, well, no, but you bought a chronic illness rider. Well, I thought I had a long-term care ride. Well, no, you have well, what's the difference? Well, they kind of do the same thing. Well, can I or can I not opt out of this payroll tax? That's, I think, where a lot of people found themselves in the state of Washington. They did planning with their clients, but the clients weren't eligible for an exemption. A chronic illness rider is absolutely going to help this person, provide them money should they become chronically ill. But the payroll tax just added another bullet point when thinking about what the most appropriate product is for your client based on their needs. So client is they already retired, they're not working, they're not going to be contributing to payroll tax. Maybe they don't care. Maybe you don't care the difference between long-term care and chronic illness in a situation like that. But for younger people, as you start planning, it's important to understand the differences. So you think about long-term care products, right? They're all regulated in the same manner. The NAIC model reg requires standardized language, standardized coverage that has to come in any long-term care insurance product, whether it's a rider, a hybrid, or standalone long-term care insurance. They all have that 90-day expectation of need where, the care is expected to last 90 days, and that's what makes it long-term care. Anything less than that, they expect would be considered short-term and not covered by long-term care insurance. Again, that's any long-term care product. You need that health license and long-term care certification in order to sell these products, which means that the producer selling them has more education than somebody who might just have an accident or a life license, to sell life insurance, right? Because they're all accelerated benefits. So every long-term care product requires underwriting. You have to qualify from a mortality standpoint. They can be paid reimbursement or indemnity, either one, and they have to include consumer protection provisions in every single long-term care product. And a lot of those really are consumer protection provisions around lapse, like unintended lapse. So for chronic illness riders, it's kind of like the wild, wild west. There's not a lot of regulation that requires these products all do the same thing. So right down to the very qualification of benefits, right? As you know, chronic illness riders could have a 90-day expectation of need, making them look like LTC, but some have a permanency requirement, which is what all chronic illness riders used to have, where they would require the condition be permanent, where there's no chance of recovery in order for that condition to trigger a qualification for benefits. So things like, hip replacement or a fall or a stroke where, somebody recovers from those residual effects, those would not be covered under a chronic illness rider with a permanency requirement. So again, differences there. Then, of course, we already talked a little bit about this, but the back end charge versus the monthly charge. I've done this presentation for a lot of people, and a lot of people don't necessarily understand the difference between chronic illness riders that have a monthly charge and then the ones that have a charge taken at time of claim, either through a reduction of the chronic illness payment or a lien against the death benefit. So that's a really important thing to know the difference between those. All chronic illness riders will pay on an indemnity benefit because they're just an acceleration of the death benefit, and you cannot restrict how those benefit dollars are used, same as terminal illness. So chronic illness, accelerated death benefit, and terminal illness, accelerated death benefit are very similar under the same tax code, the 101G, where you can't restrict the use of the benefit dollars. And they're not required to have those same lapse protection provisions that long-term care products have to have. So some might include them, the carrier might include it, but not necessarily something that will be included. And so what I mean by that, I know like just something that I get involved in here at Hancock where, somebody had an address change, they moved to, an apartment, they downsized and they didn't update their address with John Hancock because they haven't thought about us in a while and the policy lapsed, right? So we have the requirement, you have to have a third party notification go out if your premium is past due. So we would have to notify another person. Somebody was incapacitated. Somebody had actually gone to a nursing home, their policy lapsed. Since they were cognitively impaired, we were able to reinstate it because of this provision that is required to be in long-term care insurance. So it does come up a lot. And if you think about the people who are using these types of products, lapse protection is a really important thing to have if you think about people who are either deficient with ADLs or have a cognitive impairment. So this is just, again, high level to kind of give you an understanding as to why chronic illness and long-term care products cannot be considered synonymous. They can certainly both help in different ways. And it's really great we have different types of products out there now, instead of just like that one standalone long-term care insurance. That was the one product for everybody. That's all we could use. Now we have a variety of products. I mean, even for, the back-end charge ones, those are great for people focused on accumulation. They might be in their 30s, 40s, not quite focused on long-term care yet. But why not include that on their policy in case their needs change, in case the unexpected happens? All you're doing is giving them access to their death benefit on a tax-favored basis if they decide to use it. They don't have to, there's no charge for it. So they're all good, they just have different applications. So for anybody on the call who doesn't have their health license, long-term care certification, my suggestion to you is really consider doing that now so you can offer a variety of types of products. Again, I'm not saying long-term care is better, but if people are looking to offer the right product for their client based on what those needs are, based on where they live and everything else that goes along with it, just getting yourself in a place where you can offer them multiple things, I think would be a really good thing for you. So that's my call to action for you. And I think as the state legislation just becomes more prevalent, this is certainly something that could continue to, really draw that line in the sand, as I mentioned before, with the state of Washington. So most important map, and here's the map that I really think that we all need to focus on, is that the clients who live in each of these states are at risk if they don't have a plan for long-term care. So it's a little tongue in cheek, but really like everywhere, everybody needs a plan for long-term care. And if they don't have one, what's at stake is their family's emotional and physical well-being, because they're going to be forced to provide informal care, or their financial portfolio because they're going to have to pay for their care out of pocket. So don't just wait for your state to be on that colorful map, or don't wait for, an initiative to take effect. Do ongoing long-term care planning with clients because it's the right thing to do. And it's probably the product with the highest value proposition of anything within a financial portfolio, because it helps protect every other plan they have in place for a nice, secure financial retirement. So I'm going to just give you kind of our 5 pillars of the John Hancock rider, why we really believe this is a viable option for a good number of people who are looking at funding a plan for long-term care. And the first one, of course, is by having access to this tax-free dollars, you can hire people with the skill set to help provide the care that's needed should somebody become chronically ill. And when I say the skill set, people who are specifically trained in caring for people who are ADL deficient or cognitively impaired. And I use this analogy all the time. If somebody has to go to the dentist to get a tooth extracted and they have dental insurance, even though dental insurance doesn't seem to pay much these days, you go to a dentist who's going to take that tooth out in a sterile environment with sterile tools that are designed to extract that tooth safely. You're not going to go to your neighbor and have them take it out with a rusty pair of pliers in their basement, right? If you have insurance, it's what gives you access to specialized care and services. And I think we think about long-term care insurance in a very different bucket than we do other types of insurance. So keep it in mind, like it's not something that's intended to put the responsibilities back onto informal caregivers who don't necessarily have those skills equipped to take care of people who have ADL deficiencies. The second thing is death benefit preservation. And because ours is a reimbursement rider, we really believe that this is probably one of the best ways of offering benefits. is that you can really cover for a true long-term care need. And I think that's what most people are concerned about. Is it's not, the claim that lasts 6 months, not care that's needed for 1 year. It's once you start going beyond that 1, that 2, that 3 potential, 10-year need for Alzheimer's or something like that. That's what most people are insuring against, is that unknown, unrealized amount of money that could be needed to pay for a true long-term care event. So having the benefit based on what long-term care costs, as opposed to just, pushing money out of the policy without, it needed to be used, really just helps either leave more tax-free benefits for the beneficiary or extend that coverage period for the rider. And I think this is kind of a misnomer. I think a lot of people think that, high net worth clients want indemnity riders because it's cash and they can do whatever they want with it. But the reality is, like, high net worth people need protection, right? They need protection for their wealth. And being able to pay benefits in excess of the IRS per diem limit on a tax favored basis is worth something. That's a really good story for high net worth individuals. We can offer up to $50,000 per month, regardless of what happens with the per diem limit, whether it goes up or down, whatever it is. Anything paid from our rider is considered income tax free because it's being paid for qualified long-term care expenses. I was down in Charlotte a couple of weeks ago and I was doing this presentation, and a person came up to me after and said, I didn't know that the benefits could be paid and they were tax-free on a reimbursement rider. And I said, yeah. And he told me that he used to be a Hancock wholesaler for long-term care insurance. So I always like to make a fine point in this. I couldn't believe it. It was a long time ago, so I gave him that. But again, because it's being paid for qualified long-term care expenses, then those benefits are received income tax-free. And the last one is that no need to be out of pocket. And this is just, again, I think it's a misnomer when people think about reimbursement riders and reimbursement products, is they have this vision of a little old lady sitting at her dining room table on hold, surrounded by receipts, trying to get reimbursed from the insurance company. And that's not what it is. It simply means we're basing the amount of benefit that's paid from the policy on the amount of long-term care expenses incurred. That allows us to have something called assignment of benefits, which is a very, very powerful thing to be able to offer at claim time or when benefits are needed. So it allows us to send an invoice directly to the care provider, and then the care provider can pay John Hancock directly, take the client out of that kind of reimbursement, collecting receipts and invoices to try to get them reimbursed. If the family wanted to own that responsibility, they certainly could. We have a digital portal. They can do it on their phone. They can do it online. They don't have to fax it in anymore. We actually don't accept faxes anymore, which took a long time. But so there's some choices here, right? But I think when you're thinking about what actually happens when clients are cognitively impaired or have an ADL deficiency and what the family is going through, it's just a nice to have. It's another option that's going to alleviate some of those responsibilities from the family members. And when I was and Barry heard me tell this before, but I was in Florida a couple of years ago, and my boyfriend and I were sitting at a restaurant and having a drink, and this woman came down and sat next to us. She was lovely. We were talking, and she asked, where are you from? And I said, I'm from Boston. And she says, what do you do for a living? And I said, I work for John Hancock. And I barely finished saying it, and she cheered and said, long-term care insurance. And I was shocked, and my boyfriend was horrified because he says, of all the people in Florida, we had to sit next to this woman. So I said to her, well, that's actually what I do. I said, but first tell me, like, what makes you say that? Like, most people aren't cheering when I mention John Hancock or long-term care insurance. And she said, I own a home care agency. And I said, oh, I go, assignment of benefits. And she said to me, I always know I'm going to get paid. And that to me, actually, it was something I never even thought about it from the caregiver perspective, right? The people who are actually providing professional care and services to these families and to our policyholders when they need them. It's something that she doesn't have to wait for the family to first get money, and then hopefully she's on their radar somewhere and her caregivers are getting paid, right? So it's just another way that it helps kind of in that overall continuum known as long-term care to really just help the care be provided in a consistent way and those caregivers be paid so there is no break in the care that is being provided to our policyholders. So that's the end of what I had prepared for the presentation. So I'll leave our little compliance slide up there for a moment. And Barry, I'll kind of turn it back to you to bring up any
what-
questions that we
before
might
you-
have.
well, the first thing I'll do is in the chat box, I'm going to send out my email address where everyone who wants to see this presentation can email me to my email, and I'll pick it up there and send it out. You have some questions in there, Jen.
Sure. Okay, let's see.
If you want
Let me
to
see if I can see them. Oh, I can. All right. All right. Let me.
get plenty in there, so.
Okay, great. I'm just going to start at the top. How do veterans better coordinate with private LTC policies? Does it make sense for veterans to purchase private long-term care insurance? So I would say yes. I would say it's definitely worth having discussions with veterans because the VA pays benefits based on service-connected disabilities. So the more or the higher ranking, the more disabled somebody is for VA benefits, the more they're going to get in long-term care benefits. So if someone does not have a lot of service-connected disabilities, they should absolutely be having this conversation about long-term care planning. And even those who have those service-related disabilities, they're probably not going to be able to qualify for private insurance, unfortunately, which is why the VA offers a safety net. But it's worth having those conversations with those clients anyways to make sure they understand what their options are. We actually, we sell our long-term care rider through USAA as well. So they're offering it to their members, if that tells you anything. How did the Washington program address people already retired? Would they receive benefits and was there a charge to them? So if people were already retired, they were not included in WACARES. So there's no, they're not contributing anything and they're not eligible for benefits from the program. What they did address was people who were close to retirement. And so they were maybe only working another 1 or 2 years and weren't eligible for benefits because they didn't meet the contribution requirements, which was, I forget how many hours that you have to work and how many years. It was some formula for how much you had to contribute. So what they did for near retirees was create a reduced pool for people who were kind of forced to contribute for those, 2, 3 remaining years that they were working. So instead of 36.5, it'll be prorated based on what they actually contributed. The next question is from Scott. When is the California state mandate starting? We don't know, and there won't be a mandate. So that's and I'm going to bring something up too because I'm not sure if I actually said this when we talked about California. So there'll be an opt-out, right? So it's not going to. And I think what a lot of people thought in the state of Washington was people were going to have to buy long-term care insurance, and that wasn't it. It was people were going to be auto-enrolled in a payroll tax if they didn't buy long-term care insurance. So it's just a little shift in the perception. So California won't have a mandate for people to buy private insurance, but there will be a requirement to contribute via payroll tax, either employee or employer, or income tax for self-employed if they pass new legislation to create a long-term care program in California. So we don't know the date of that yet. Personally, I don't think we'll see something next year, but I don't know that for sure. It's just my feeling. I just feel like there's so much work to be done. But it's not to say don't get going on this because having those conversations now is what's going to give somebody the opportunity to opt out. What I wanted to say that I think I failed to mention before is that we're not going to see a one snapshot opportunity for people to opt out from what California is doing. They're looking at creating the potential, like a potential ongoing incentive to purchase private coverage. Again, whatever they define that private coverage to be. And that would be what they're proposing is a reduced contribution. So think of it in the sense that I missed the opt-out or I didn't have long-term care insurance prior to whatever the implementation was, but I buy it after the fact. Instead of me contributing 1%, maybe I only have to contribute 5% because I bought private coverage. So it is going to be a lot different than what we saw in Washington in that regard. And it is creating that ongoing incentive for all of us to continue having those discussions instead of like November 1st, everybody shuts down and nobody talks long-term care ever again. So I think that's a really good thing. And that seems like it's a really nice way of working between the state and the private market. And what they're also doing is really working with the private market now to come up with some of those wraparound products, the ones that will align with whatever program they decide, if they decide to establish one. So a little bit different than what we saw in Washington. If I didn't answer any of these questions, feel free to just ask me to, kind of go over it again. Please touch on group LTC coverage. So touch on group. So what I'll say is, this multi-life is, I think, making its comeback. I was at a conference in March. It was the Intercompany Long-Term Care Insurance Conference. And it was like going back in time. It was 900, long-term care specialists and carriers, and not necessarily, I wouldn't want to say carriers and BGAs, but so much of it was wellness companies, like really companies out there really trying to help kind of shift what the focus is of the long-term care industry, which is really keeping people healthy, keeping them in their homes as long as possible, because that's what, customers want. And that, of course, is the most cost-effective way of doing it. So what we're seeing is definitely a huge uptick in the type of products that are out there in worksite. Because if you think about it, what we saw was like people wanting to offer long-term care insurance to groups of people, right? When we saw this play out in Washington, they went to employers and said, knock, 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 let us in. Your employees are going to be, enrolled in this payroll tax unless they have long-term care insurance. And I think that's what started the opportunity. So I expect we're going to see a lot of companies getting into this market. And if California comes through with, not just the employee contributing, but the employer contributing, think about the incentive for employees to be offering some sort of long-term care program within the group. So I think it's definitely on the rise. And, buying private insurance, I think you don't have the same issue with portability, right? Like if you leave your job, you can take your group long-term care insurance with you. So it definitely has a lot of advantages. Of course, you can tailor it based on whatever the parameters are of that employer's offering. So expect to kind of see a lot more of that. And again, people don't necessarily have to buy it through their employer, right? Because if they're healthy and they can get a better deal on the private market. But again, it's one of those things that's going to help continue to keep this in the forefront of your client's mind by just this constant reinforcement that this is a problem that needs to be solved. So let's see, Belinda is saying, what would the reason that they say people have to have their own plan in order to opt out, if not to control and have mass people on a state plan? The reason they say people have to opt out of their own plan in order to then opt out. What would they say people have? So I think what you mean is like, why are they letting people opt out if they have their own private insurance? And if that's not the correct answer, just let me know. So the reason that they're kind of incentivizing people to buy insurance is because if they have insurance, it's what's going to keep them off of Medicaid, right? If I buy private insurance and I bought a life insurance policy with a long-term care rider on it, and it's $1 million worth of death benefit, I'm going to have to go through that $1 million worth of death benefit before I can even consider Medicaid, never mind, all of my other spend down I would have to do. But if you think on like a smaller scale, somebody who's, might have a long-term care insurance policy, maybe it has $200,000 worth of benefits, at least spending that policy first, again, will still help defray Medicaid spending. So the incentive is really to get customers or to get consumers to start thinking about paying for their own long-term care, to do planning that they can afford to pay for long-term care so that it doesn't fall on Medicaid, because Medicaid wasn't designed to pay and it's not funded to be the primary payer for long-term care, but it is. So that's the whole point of it, is really just trying to incentivize people to do their own planning so that this doesn't all just fall to Medicaid to be the catch-all for people who actually have means. It's really intended for people who don't have means. Okay, so we already talked about the slides are going to be sent out if you email Barry. And then short-term care. What about short-term care that covers you for 360, I think it's 364 days. I would be surprised if short-term care counts, but I don't know. That's actually a really good question. But again, it's going to go back to the states really understanding what is short-term care versus long-term care, right? Will it help defray Medicaid spending? Absolutely, right? If somebody has a product that's going to pay for the first year of long-term care, yeah, it's definitely going to help. But I think the challenge will be the states getting kind of educated around the difference and the nuances of these products. And hopefully, if they even understand what short-term care is, because it's not long-term care. So if it's a long-term care task force, is it even on their radar? So that's just some of the, again, the nuances of these products that I think we have to understand that the states might not have that information. Based on what we know now, please clarify again whether California 567 exemption will include chronic illness. We don't know. Just to recap, they haven't defined what private insurance will be. There is some lobbying going on out there for them to include chronic illness products, particularly from companies who have a chronic illness rider with a monthly charge. One of the proposals, I'll just share this with you, when I was at that conference, one of the proposals was, what if we allow people, if a producer has their long-term care certification and their health license, and they sell a chronic illness rider, we'll allow an exemption for that chronic illness rider. And I said, well, how is it going to be on the consumer to figure out what type of licensing and training the agent has? And then who's going to determine that at the time of opt-out? Like, I don't even know how you'd track that. And she said, oh yeah, that doesn't really make sense, does it? So they're trying to get creative. It hasn't been defined. But again, if you're concerned about whether or not it will or will not include chronic illness, your best bet is to offer a 7702B rider, because it is considered long-term care insurance. And again, I can't tell you for sure what's going to be the definition, but I will just say that, again, risk and consequence, it's probably higher risk to sell a chronic illness rider and have it qualified than long-term care insurance. But we're also waiting for the task force to come back with what those minimum amounts would be as well, because I do think they will be establishing some sort of minimum benefit criteria to be eligible for an exemption. So $50,000 face amounts and tiny policies are probably not going to be eligible. What if you want your long-term care money and want to pay your own vendors? Oh, absolutely. So we're, by the nature of how our rider is written, we always pay the policyholder. So if somebody needs the insured qualifies for long-term care insurance, qualifies for long-term care benefits under their LTC rider, we will automatically pay those benefits to the policyholder. At time of claim, they can decide to assign benefits, which is a one-page form, and then let us obtain bills and pay the vendor directly. But that's an option at claim time. If the policy owner wants to handle the reimbursement themselves, that's the default. So they would do that through, we call it our LTC storefront or LTC portal. It's a platform that's web-based, and they can upload invoices from their phone or from a laptop. So it's become pretty seamless over the years. Of course, they can just call us as well to get that done.
Hey, Jen, can I jump in?
Please do.
Spend a second. I think what separates you from everybody else, you being John Hancock, is the concierge effort. You guys have been doing this a long time. The quality of people that handle the long-term care inside of John Hancock is exceptional. So anyone that gets involved, just spend a little time.
Yeah, no, absolutely. I mean, I think that's the difference. And I think that, if you think about the offering long-term care products and offering chronic illness products, there's a reason why we see so many chronic illness products in the market. And that's because offering long-term care insurance is a real challenge from a carrier perspective. You can't just have an area where you're just sending out checks. Like, you have to, different reserving requirements. There's different requirements for lapses, I mentioned. So you actually have to have a whole infrastructure built out to support long-term care claims. Of course, John Hancock, we have a number of things that I think that do set us apart. One is obviously when you go on claim, there's actually like case managers who are on the claim along with the client, right? So it's not like we're just sending them money and then they're on their own. And I think that's part of companies who don't go down the long-term care road. They're looking to get in the market and then just either sending a check or doing, and I say sometimes it's even worse, just a simple direct deposit of $10,000 or more into a client's bank account without any type of oversight creates a lot of opportunity for fraud. And, the reimbursement nature of how we pay benefits really acts as a safety net as well. And again, having a reimbursement rider requires a lot of infrastructure. So it is something that we really do believe that the opportunity for us to continue offering a reimbursement is a viable thing, and we will keep doing it. But we also see the opportunity in indemnity as well. And I'm hoping that we can maybe offer both at some point in the future. But, we also have something called provider pathways, and that's like a third party. And a lot of people get confused. They're not in our claims department, but provider pathways is a third party. They're not, connected with John Hancock. They don't do the benefit determination or anything like that, but they're available to not just our policyholders, but even if I bought a long-term care insurance rider, but my parents didn't have insurance, I could use their services on my parents' behalf if they needed care. And so I could contact them. They can help me find care and services that might be wherever my parents are located. They'll negotiate discounts on the care and services and then make those referrals over to me. And they do that with a lot of types of long-term care services that might be needed. Some that are covered by long-term care insurance, some might not be. I mean, even like hearing aids and stuff like that. So it's just another added service to really help people navigate the whole long-term care continuum. We're paying like $1 billion in long-term care claims a day. There's a reason why, long-term care insurance companies are unfortunately having rate increases every year, but it's because we're paying claims. Like we're paying so many claims that's not the black eye that the long-term care insurance industry has. We're very good at paying claims, which has resulted in the need for these rate increases. So, a long history since I think 1986 was our first long-term care insurance policy.
All right, Jen, if I bring down your screen so we can see you talk while you're going through this also.
Oh, absolutely. Oh, let's see. Stop sharing. Oh, there we go. Okay.
All right.
Thank you. All right.
Much better.
So what products do you recommend for California clients? I guess, Barry, I'll let you recommend anybody else besides John Hancock's long-term care rider. but I will say this, right now, the opportunity, we filed our LTC, the version of our rider that was selling everywhere else in California is our 18 version, 2018. In California, we're still selling a 2005 version of our rider, and that's because California has been holding our 18 rider for the past 5 or 6 years and has not reviewed it or approved it yet. So the pricing in California for our rider is really advantageous from a purchasing perspective. I've actually talked to people about going to move out to California for a little while so I can buy my own rider as a California resident because it's priced that well, especially for females. So, reach out to Barry if the Hancock rider is not the best option. I'll let you opine on that. Is it not true that a few companies pulled out of Washington state as the actuarials do not work? Many, many young getting the least cost option does not help cover the older population. I heard several companies pulled out. Is this not true? Let's see, this is Belinda. Belinda, are you referring to pulling out from selling long-term care products? Is that or is it just like long-term care insurance in general? I think maybe you're saying the carriers pulled out of Washington state because of pricing. I'm not sure, but maybe if you want, I don't know if we can unmute Belinda to clarify. Or I'll try to answer it. So the reason why I think a lot of carriers opted out, or I should say shut down in the state of Washington, was the primary reason was we were getting inundated with applications. A lot of them, the majority were coming from 20 and 30-year-olds, which told me that this is a problem at the very beginning. 20 and 30-year-olds racing to buy long-term care insurance is typically not going to be a good thing. That's not really how it works, but it was obviously an anomaly. Number two, the size of the products were so tiny that it was really causing a blockage in the pipeline. So, as people are submitting business in other states that were for, estate planning and everything else, it was just slowing everything else down with these $50,000 face amounts. And then most importantly, what I was most concerned about was the lapse potential on these policies. So if people were literally just buying this $50,000 policy that we're now underwriting, and as soon as they get approval, they submit for their exemption, and now they lapse their policy. That is not a good pricing game for us, right? And it's not a good pricing game for the producer because one, it costs us money to underwrite and go through the process. It costs you time to kind of get that done. And then if we're charging you back because the policy lapses, it's just a kind of a big waste of time. And at the end of the day, this person doesn't have long-term care coverage and they're exempt from the Walk Years program. So it creates the very problem that they're looking to solve, which is, people ending up on Medicaid. So that's kind of what happened in the state of Washington. I hope that answers the question. What John Hancock products have the LTC rider available? All of our permanent single life products. So it's just not available in our joint policies or in our term policies. So any single life permanent product. I think the last,
Jen, real quick,
yes.
we have excellent local supporters, you know, in Kevin Yurkovich, and Kevin's on with us. Kevin, you want to expand on that question?
made it.
Barry, can you hear me?
Yes, I can.
Yes.
Unfortunately, yes. Go ahead.
Hello, everybody. I'm in the car, so I apologize for not being on camera, but I just thank BGA for the opportunity. And Jen, I call her affectionately the long-term care czar. There's nobody better at any carrier that represents knowledge and expertise on this subject matter that I've ever seen or heard than Jen. So to have her as a resource is tremendous. Please work with your contacts at BGA to have further discussions with Jen or I about this important topic. And I just want to take 2 minutes and reflect back of why I'm so passionate about this topic. When I was 13, my grandfather passed away, and my grandmother bought a condo at Freedom Village Nursing Home on El Toro Road in El Toro, California. I think they now call it Lake Forest, but you get the point. She was very independent. She'd go downstairs for lunch and dinners and have social times. And unfortunately, as her health deteriorated, she was moved into an assisted living facility within that building, and then ultimately had to move to a 24-hour care facility on a neighboring building within the same property. And she basically lived her last 4 or 5 years in a bed under total 24-hour care. So she signed a contract when she bought this condo that wouldn't be something they would offer today. And what it said was, we'll take the equity of your condo over time, almost like a reverse mortgage. We will also take all your Social Security and your pension income. And even if you run out of money, we cannot kick you out of this facility. Well, they lost financially really significantly on my grandmother. They took approximately $500,000 in Social Security, pension income, and equity of her condo, and then had a bill on top of that for $457,000 additional dollars. So her total cost of care approached and or may have exceeded, based on our estimates, $1 million. And so we all have a long-term care plan. Every one of us on this phone call does. We're either going to use a product like Jen's been talking about today, or we're going to pay for long-term care dollar for dollar out of our estate. And when you have a family member that you can reference and look at and go, boy, how could we have paid or afforded $1 million? It's just something that we really need to take seriously. Healthcare costs and long-term care costs and longevity are the number one reason a successful financial plan won't reach its conclusion successfully. So Jen, Barry, thanks for the opportunity. I'm here locally in Southern Cal. Would love to see you guys in person. So all the team knows how to get a hold of me, and anything we can do to support you guys, it's certainly our pleasure.
Okay, real quick before you jump off there, Jen, you got one more for Julie Young, but there is a product coming from John Hancock that we at BGA have been working very closely with Hancock, and it's a group life policy with a long-term care rider and vitality. And that'll be out in the next month or two, or you'll be able to start submitting censuses on companies. And it'll be a leader in the marketplace with this product. There'll be anything even close to it. Pricing is better than anything else, and all the benefits you're going to get will be better than you'll see with any other product, which there's very few out there.
Good. I'm glad you. I'm glad they talked to you about this. I'm trying to get as much information. You probably know more than me, but yeah, it is something that we're currently working on, and it'll all be digital too, which is nice. If anybody gets sick of taking
that's a good point. It'll be digital and be real-time underwriting. You'll get a decision as soon as you finish answering the sets of questions, which are free. It takes about 10 minutes.
Okay, so the last question was, in addition to employee payroll deductions, will there also be an additional income tax for retirees? That's a good, I don't think so. I don't think that's what's being proposed at all. I think retirees, similar to what we saw in Washington, will just be exempt from the program because they wouldn't be contributing. It would be for self-employed individuals. So however they file, that's probably how it would be applied from an income tax perspective. Again, all up in the air, but I'd be surprised if we saw anything for retirees unless they were requested to be opted in, unless they requested to start contributing and there was some sort of way that they could do that. So, and if you have questions, Barry, that come in after or whatever, feel free to, share my email or just send them to me directly.
All right. Any last questions that could put in the chat or open up your microphones and ask right now?
Very
Okay. Well,
fluid
Janet,
time.
Good
Oh, yes.
Go ahead,
good
I'm
morning.
Good morning.
Good morning. This is Rich. Jennifer, thank you for the answer
Rich.
to the questions along the way.
Welcome.
And the question about veterans, is there a way that I can chat with you some more about that after
Sure.
this
Absolutely.
call?
Yeah.
How would I get
Barry,
in contact with you?
Yeah, Barry, do you want to send out my contact information?
Yeah.
Okay,
So
so Barry
Rich-
will send it out. And what I can do is also send some of the information I have on veterans benefits to Barry, and he can share that as well.
Rich in
then
the
feel
chat
free to
box.
give me
is
Thank you so much.
Yeah, Rich in the chat box is my email address. So send it to me and I'll forward it on.
Got it. Thank you.
All right. Well, if that's it, Jen, once again, you prove you are the expert in this
Oh,
business.
great.
And excellent job. And I'm
Great.
sure the next month or two we'll circle back because
Definitely.
California is going to have some announcements soon. And we'll have a reason to do this again.
Yeah, definitely.
All right. Thank you, everybody.
Thank you so much. Thanks for having me. All right.
Bye-bye.
Bye.